Well, I think markets are in consolidation phase right now. I think 20% down, as you indicated, is bear market territory. And there are a number of sectors that are starting to look appealing. But I would be very careful, Karen. I wouldn't be jumping in head first into these names. I still think there's lots of uncertainty around what the Federal Reserve is going to do and if they're going to tighten too much and dip the U.S. economy into recession. So I'd be buying and nibbling, but I wouldn't go full in because I still think there's lots of volatility ahead of us.
If I can just bring in the latest from Jay Powell, effectively warning about the multiple different shocks and how this could transition to a higher inflation environment or regime. That's what they're trying to prevent. But if you think about the language and the promises that have been made so far around tackling inflation with much higher interest rates, is there any chance that we really are setting in for an entrenched inflationary regime?
I don't think we're headed into entrenched inflation, but I do think we're going to have aggressive policy moves by the Federal Reserve. And I believe them that they're going to increase interest rates here in the United States by another 0.75%. That's already having a chilling effect on the economy. I'm of the belief if we're not in recession, we're about to be in recession. You're starting to see companies be hesitant in terms of job hires, and you certainly are starting to see an impact in terms of real estate. So I don't have evidence yet that we're going to be in a long-term inflationary environment because I think eventually the Russia-Ukraine situation will calm down, hopefully sooner than later. And that's a big spike towards inflation. Eventually supply chain issues through China, that is now starting to finally open up, will be resolved. But I think the greater risk is, as Jay Powell said in his recent testimony, his greatest fear is that there's not price stability, that there's runaway inflation. And I think they're going to do everything they can to bring the interest rate hammer down on inflation. And I think that puts us at risk of moving into a recession.
Michael, good morning. Juliana here. I certainly take your point that you do firmly expect the Fed to continue raising interest rates and to go for the more aggressive 75 basis points. But what about a few months out? What about the risk that the Fed flip-flops, like we've seen many central banks forced to do in years past, and effectively stop-start when it comes to rates?
Well, it's interesting you bring that up because I think that's probably what's going to happen. I think what's going to happen is inflation is runaway right now. Federal Reserve is going to bring out these multiple very, very strong signals that they're looking to control inflation. It's going to dip the economy into a slow growth, stagflation or a recessionary environment. And then I think the Fed's going to start cutting rates again later on this year. So I don't necessarily see that as a negative thing. If the Federal Reserve moves us closer towards recession and breaks the back of inflation and has to cut a little bit to stimulate the economy, I don't think that's necessarily a bad thing. And I think that's actually starting to be built into our base case scenario, that there's going to be some interest rate relief after inflation is actually hopefully broken here in the near future.
Michael, that sounds like an incredibly difficult environment for investing if we do see this sort of flip-flopping from the Federal Reserve. You mentioned to Karen that you do see some opportunities to nibble. I think that was the word you used when it comes to markets. What would your best trades be right now?
Well, I think that you want to look at big tech. I think big tech certainly is trading off at a discount. I think there are a number of retail names that are trading significantly at a discount as well. I'll tell you what I would probably not be doing would be throwing lots of money in emerging markets. I think that emerging markets are going to continue to struggle, particularly Asian emerging markets. I also would be hesitant to pile more money into commodities, even though oil has been an outperformer. And I think it was Carolyn outlined the difference between the Dow and S&P is really basically because of what's happening with energy. I think you just need to be careful. It is going to be a difficult environment, and that's why investors need to be really looking at their portfolios and asking themselves, what do I own right now that I want to own in 2 years or 3 years or 4 years or 5 years after we get through this difficult spell? If you can't see out far past that time horizon, you might really want to ask yourself if you really want to be in those names. And I might also add, if a company has promised earnings but has no earnings or has no PE ratio, be very, very careful, because as we've seen, that could be a brutal space to play in.